What to do with $5,000 in your bank account. In today's world, managing your money wisely is crucial, especially when inflation and economic uncertainty are increasing the cost of living. Understanding how to allocate your funds effectively can help you maximize your financial potential. This report explores the best strategies for managing your $5,000, offering insights into saving, paying off debt, and making the most of your money in a way that aligns with modern financial realities. Footnote: managing your savings and debt effectively is essential in today's economic climate. The importance of savings. While savings accounts are traditionally viewed as a safe haven, they no longer provide the same financial benefits they did in previous generations. Due to inflation, the value of savings is continually eroded. However, having money saved for emergencies remains essential. The first step in financial management is to ensure you have a financial cushion for unexpected events. It is recommended that you have at least $2,000 in your savings account to cover emergencies such as car repairs or unexpected medical expenses. Beyond this, it is important to save between 3 and 12 months' worth of living expenses. The specific amount you need will depend on your personal risk tolerance. Footnote: savings are essential for emergencies, but saving too much in low-interest accounts may hinder financial growth. Saving for big purchases or investments. After securing an emergency fund, the next step is to save for larger purchases, such as a down payment on a house or a car, or to accumulate funds for investments. If you are unsure where to invest, it is acceptable to save in a low-interest account temporarily while considering investment options. However, once your savings exceed what is necessary for emergencies or major purchases, it is more advantageous to shift your focus to investments that have a higher return than traditional savings accounts. Footnote: savings for large purchases or investments should be limited and shifted to higher return opportunities when possible. Inflation and its impact on savings. The reality is that inflation significantly reduces the purchasing power of your savings over time. In previous generations, savings could lead to wealth accumulation, but today, they primarily serve as a safety net. You cannot rely solely on savings to build wealth. This does not mean you should stop saving, but it is important to save wisely. For example, transferring some savings to high-interest online savings accounts can provide a better return. These accounts typically offer higher interest rates due to their lower operating costs compared to traditional brick-and-mortar banks. Footnote: inflation makes saving alone insufficient for wealth creation. Higher returns on savings are needed. Paying down debt with savings. One of the most effective uses of excess savings is to pay down high-interest debt. For example, credit card debt often carries an interest rate between 18% and 25%, which is significantly higher than the return from a traditional savings account. By using your savings to pay down high-interest debt, you effectively earn a guaranteed return on your money, avoiding the high interest you would otherwise pay. This strategy is more effective than leaving your savings in low-interest accounts, as it helps reduce your overall debt burden while providing a guaranteed return. Footnote: paying down high-interest debt provides a guaranteed return, often higher than any savings account interest. Low-interest debt and investing. If you have low-interest debt, such as a mortgage or student loans, it may not be as urgent to pay off this debt using your savings. Instead, you may choose to invest your money, particularly if you are comfortable with higher risk for potentially higher returns. Investing in stocks, real estate, or other assets could provide better returns in the long run, but it is important to evaluate your risk tolerance and long-term financial goals before making investment decisions. The key is to ensure that your investments align with your financial objectives. Footnote: low-interest debt can be paid off slowly while investing for better returns if you can manage the risks. The importance of avoiding unnecessary financing. Financing non-essential purchases, such as electronics or luxury items, is a key factor in why many people struggle financially. The cost of financing items you don't need can quickly add up, especially when interest rates are high. Instead, focus on avoiding unnecessary financing and only take on debt for significant purchases, such as your home. Building wealth requires financial discipline, and one of the best ways to avoid financial struggles is to limit your reliance on credit for purchases that do not increase your long-term financial value. Footnote: avoiding unnecessary financing helps prevent financial strain and fosters long-term wealth accumulation. Conclusion: with $5,000 in the bank, your primary focus should be to establish a solid financial foundation. First, save for emergencies, then pay down high-interest debt, and finally, consider investments that offer higher returns than traditional savings. Avoid unnecessary financing and focus on making your money work for you, rather than letting it lose value due to inflation. Footnote: a balanced approach to saving, paying down debt, and investing can help you build wealth over time.